Welcome back to Talk Tickers. This is the show, where we strip down the earnings calls so you don't have to suffer through all that hold music.
Or the bad audio connections.
And the bad connections, the polite executive small talk. We get to what actually matters for your portfolio.
That is the mission. And today we have a fascinating one on the desk. We're looking at MGIC Investment Corporation. Ticker is MTG.
Right. And the Q4 2025 print, it dropped yesterday afternoon. And the call itself wrapped up this morning, February 3rd.
Mm-hmm.
And look, we have to address the elephant in the room right off the bat. The market. Well, the market did not like this report.
No, not one bit. It was a rough morning for anyone long that stock.
It wasn't just a stumble. It felt like a rejection.
Oh, yeah. The stock took a huge hit immediately. It gapped down, about 6.7% in the pre-market?
And it just stayed heavy all day. Closed down around 5.2%. That's a big move for a company like MGIC.
It is. This is supposed to be a steady, boring insurance utility. A 5 or 6% drop is a real signal.
So that's our mission for this deep dive. Is this a buying opportunity or is this a big warning sign? It really feels like a classic good news, bad news situation, doesn't it?
It is the perfect example of one. It's a tale of two different financial statements.
How so?
Well, on one hand, you've got the bottom line, the balance sheet. They look rock solid. I mean, almost impregnable.
Okay.
But on the other hand, you have the top line, the revenue, and the forward guidance, which frankly just spooked the street.
Okay, let's unpack this, and let's start with the bad news, because that's clearly what the trading algorithms locked onto first thing this morning. We had a miss on the top line. Run us through the damage.
So total operating revenues came in at $298.7 million.
Okay, and the street wanted.
The street, the analyst consensus, they were looking for about $308.2 million.
So that's a miss of, what, $9.5 million?
About $9.5 million, yeah. So percentage-wise, you're looking at a 3% miss.
A 3% miss. I mean, it doesn't sound like a total disaster. In tech, that's just a Tuesday.
Right. But in this industry, in mortgage insurance, a 3% miss feels heavier.
Yeah.
It suggests the core engine isn't revving up like people hoped.
Predictability is what you're paying for here.
Exactly. A miss like that, it signals stagnation. It tells the market that the business is maybe shrinking a little bit faster than they thought. And that revenue figure, it just completely overshadowed the good news.
Which was the earnings per share.
The EPS, yeah.
So let's look at the bottom line. They actually made more money than expected.
They did. GAAP diluted EPS came in at $0.75. The consensus was looking for $0.74.
They beat by a penny.
A penny beat.
Which is fine, but obviously not enough to save the stock today.
No, because investors are smart enough to look at the quality of those earnings, right? When you beat on profit but you miss on revenue, it usually means you got there by cutting costs.
Or some kind of financial engineering.
Exactly. It's an efficiency beat, not a growth beat. And the market wants growth.
Okay, but here is where it gets really interesting for me. This is the paradox of the whole quarter. The stock drops, but the actual intrinsic value of the company, it's shot up. I'm looking at the book value per share, and it's sitting at $23.47.
That is a massive number.
Yeah.
And that's a 13% increase year over year.
So let me get this straight. The stock is trading down in the mid-20s, so it's barely above its book value, even though that book value grew by double digits.
That is the disconnect. That's the whole story right there. You have a company that is, on paper, worth significantly more than it was a year ago.
But the market doesn't care.
The market is discounting that value because it doesn't see future growth. It just sees that operational efficiency quarter, not a growth quarter. And in this environment, if you're not growing that top line, you get punished.
Okay, so the market's punishing the lack of momentum. Let's dig into why that momentum has stalled out. And that brings us to the guidance. I think that was the real wet blanket on the fire today.
It definitely was. The most controversial part of the call was the 2026 outlook. Management said explicitly that insurance in force or shore is expected to be relatively flat in 2026.
Relatively flat. Oof. That is not what growth investors want to hear. They've got, about $303 billion in insurance in force right now?
Yep, around there.
So why is it stalling? Are people just not buying enough houses?
Well, to get that, you have to understand the mechanics of this business. It's like a seesaw between two big forces, refinancing and persistency.
Okay, walk us through that seesaw. What is persistency in plain English?
Sure. So persistency is it's a fancy industry term for customer retention.
How many people stick around?
Exactly. How many people keep their policy year after year? And right now, MGIC's persistency is incredibly high. It's around 85%.
Because nobody's moving.
Yeah.
Rates are too high. If you got a 3% mortgage from 2021, you are not selling.
You're not selling, you're not refinancing, you're staying put. You keep paying that mortgage and you keep paying that mortgage insurance.
So that's good for MGIC. Sticky customers, reliable cash flow.
It's great for them, but that's only one side of the seesaw.
So where's the problem?
The problem is the other side. New insurance written, or NIW. Because rates are so high, home sales are sluggish.
Right. First-time home buyers are getting crushed.
They're priced out. So MGIC isn't adding new customers fast enough. They wrote about $17 billion in new business in Q4, about $60 billion for the whole year. It's solid, but it's not explosive growth.
And on the call, management painted this picture of a catch-22 for 2026, didn't they?
They did. It's a fascinating economic trap they're in. They basically said, look, if interest rates drop in 2026,
which everyone hopes they do.
Right. If they drop, refinancing and home sales will pick up. That means they'll write more new business, which sounds great.
Right.
But if rates drop, all those people who are stuck in their homes right now, they're finally going to refinance or move.
And when they do that, the old insurance policy gets canceled.
It gets canceled. Persistency will drop like a stone.
I see. So if rates stay high, no new growth. If rates drop, you lose your existing base.
Precisely. It all nets out to zero. They were just running on a treadmill, sprinting to stay at that $303 billion in force.
That explains flat. And it explains why the market is so grumpy. It feels like they're totally checkmated by the Fed.
They are.
But I think this is the pivotal part of the story. MGIC isn't just sitting there. They are doing some pretty intense financial engineering behind the scenes to make money anyway.
This is where we have to talk about reinsurance. I know listeners' eyes glaze over when we say that word.
It sounds like homework, I get it.
It does. But this is actually where the shareholder value is being created. If you want to understand why the stock might be a deal, you have to get this part.
Okay, so management seemed way more excited about their reinsurance treaties than they did about the housing market. They kept mentioning quota share. Break that down for us. What are they doing?
Let's simplify it. So mortgage insurers like MGIC, they're required by law, these regulations called PMIERs, to hold a massive amount of cash in a vault.
It's their rainy day fund, in case everything goes wrong.
It's a mandatory safety net. But holding cash in a vault is super inefficient. It doesn't earn much. So MGIC uses these quota share agreements. They go to these big global reinsurers and say, hey, we will give you a slice of our premiums.
If you agree to take a slice of the risk.
You got it. They offload the danger.
And why does that help the bottom line?
Because of the capital rules. If you offload the risk, the regulators say, okay, since you don't hold that risk anymore, you don't need to hold as much cash in the vault.
It frees up the war chest.
It frees up a massive amount of capital. On the call, management said these moves reduced their PMIERs required assets by about $2.8 billion.
Wait, say that again?
$2.8 billion. That's a 47% reduction.
Whoa. They cut their capital requirement in almost half.
Almost in half. Imagine you suddenly find out you only need half the inventory you thought you did. That frees up billions of dollars that was basically trapped.
And that hits the P&L directly.
It does, because the reinsurers pay MGIC something called a ceding commission. It's basically a rebate for giving them the business. And that rebate lowers MGIC's operating expenses.
Okay, so let me get this straight. The business itself, the actual number of policies, that's not growing. It's flat.
Correct.
But the cost of running the business is shrinking because they're engineering the risk off the balance sheet.
You've nailed it. They are shrinking the cost of the revenue faster than the revenue itself is shrinking. It maintains the margins. It's defensive, but it's brilliant.
Which leads to the next logical question. If they've freed up all this capital and they don't need to invest it in new growth, where is all that money going?
It's going right back to the people listening to this, the shareholders, which brings us to what I'm calling the capital cannibal strategy.
I love that, the capital cannibal, because they are basically eating themselves.
They really are. In 2025, just between dividends and share buybacks, MGIC returned $915 million to shareholders.
Almost $1 billion. On a company with what, a $6 or $7 billion market cap? That is a huge yield.
And it gets better. Look at the share count. They reduced the number of shares outstanding by 12% in a single year.
12%.
Think about that math. Even if the company makes the exact same amount of profit next year, zero growth, your earnings per share still go up by 12%.
It's the pizza slice theory. You're not making a bigger pizza, you're just cutting it into fewer, bigger slices.
Exactly. And they are not stopping. They bought another $73 million worth of stock just in January of this year. They have $1 billion in cash at the holding company and another $2.5 billion in excess capital. They have a massive war chest to keep buying.
So the drop in the stock price today is actually good for the buyback strategy.
Ironically, yes. If you believe in the long term, you want the stock to be cheap so they can retire even more shares. If the stock shot up to $30 tomorrow, their buyback dollars just wouldn't go as far.
Let's touch on that long-term view for a second. We've talked about the risk of stagnation. What about a crash? Did we see any cracks in credit quality on the call?
That was the dog that didn't bark. The credit report was incredibly clean.
No spikes in defaults, nothing.
Nothing. In fact, they had a $31 million favorable reserve release. That means they had money set aside for losses that never even happened.
So they got to move it back into profit.
Mm-hmm.
What about geographically? Any trouble spots? Florida, maybe?
Nope. Analysts asked about that specifically. Management said delinquencies are stable everywhere. No specific region is showing any divergence. People are paying their mortgages.
Why is that, with everything being so expensive?
One word: employment. It all comes down to jobs. If you have a job and you have that 3% mortgage, you will do whatever it takes to pay it. As long as unemployment stays low, the credit quality for MGIC stays pristine.
So the credit is clean, the capital is plentiful, but the growth is zero.
That is the perfect summary.
Okay, let's zoom out. The stock's down 5% today.
Yeah.
Is this a value trap or a golden opportunity? Because I can see both sides.
Oh, you really can. Let's play devil's advocate. The bear case, which is what the market priced in today, is that this is a melting ice cube. Revenue missed. Guidance is flat. If you're looking for a growth story, this is not it. You're betting entirely on that financial engineering to prop up the EPS.
And if housing really takes a hit, that engineering might not be enough.
Exactly. So that's the bear case. It's managed stagnation.
Okay. And the bull case?
The bull case is that you're buying a money printing machine for basically what it's worth on paper. You're buying a company trading near its book value of $23.47, a company that is generating a 13-14% return on equity and is literally cannibalizing 12% of its shares every year.
It's just a cash machine.
It is. If you're patient, the math of the buybacks has to create a floor under the price eventually. You're getting a huge yield while you wait.
And there's a macro signal here too, isn't there? I mean, if MGIC says 2026 will look like 2025.
It tells us they don't see a boom and they don't see a bust. They see stagnation. They see a muddle through scenario.
A muddle through, which honestly sounds boring, but boring can be profitable.
Boring is often very profitable. The exciting stocks are the ones that blow you up.
Which brings us to my favorite part of the show, This is not financial advice segment.
The big disclaimer time.
Exactly. We are not financial advisors. Do not do this. This is just a thought experiment. But based on what we heard today, I have a trade idea.
Let's hear the pitch.
I call this the infinite cannibal arbitrage.
Okay, that sounds a little ominous.
It is. But here's the thesis. MGIC is taking itself private in slow motion. The business isn't growing. Management admits it. But the share count is plummeting. So the trade is, you go long MTG, you buy the stock.
Okay, basic value play. You like the book value discount.
But you hedge it. You short a housing ETF, something like ITB.
Why the hedge?
Because the only thing that really kills this story is a housing crash. If housing crashes, their losses spike, and the buybacks have to stop. So you short the housing market to protect against that one specific risk.
Smart. So you're isolating the company-specific mechanics.
Exactly. But here's the kicker. You sell out-of-the-money call options against your MGIC position.
Writing covered calls. Aggressively.
Very aggressively. Why? Because management just told us the business is flat. The stock has no catalyst to skyrocket to $50 a share.
Sure.
So cap your own upside, collect the option premium, collect the dividend, and let the buyback machine just churn away underneath you.
So you're harvesting yield from three sources: the dividend, the option premium, and the accretion from the share buybacks.
Exactly. You don't even care if they sell another policy. You are purely harvesting that 13% ROE and that 12% share count reduction. It's a boring money printer disguised as a stagnant insurance stock.
You know, I have to admit, the math checks out. If the share count drops 12% a year, the stock price mathematically has to go up over time just to maintain the same valuation, as long as earnings don't collapse.
And we hedged against the earnings collapsing from a macro event.
It's cynical.
It is deeply cynical.
But it's plausible. It's an arbitrage on the company eating itself.
The infinite cannibal. You heard it here first.
The only real risk is you miss out on a surprise housing boom. The stock could rally hard, and your shares get called away.
That's a risk I'm willing to take for steady cash flow in a sideways market.
Fair enough. It certainly aligns with the thesis management put out today.
All right, let's wrap this up. Recap of the day. MGIC Q4, EPS beat by a penny.
Revenue missed by about $10 million.
And the stock gets hammered, down about 5%, because the guidance for 2026 is just flat.
But underneath all that, book value is up to $23.47. Credit is pristine, and they are buying back stock hand over fist. Over 12% of the company just gone in a year.
It's a battle between the lack of growth and the abundance of capital return. Today, the lack of growth won the day.
But tomorrow, that capital return might start to look pretty attractive at these prices.
I think that's the right way to look at it. As always, this deep dive is for entertainment and information only. Do your own diligence.
Please check the numbers yourself.
We will catch you on the next print. Thanks for listening to Talk Tickers.